Greetings. I'm Nick Sherman's President and Chief Investment Officer of Pure Portfolios. We are back with our monthly video series. This time the month of May is up. It's been a crazy month. It's been a crazy year. We're going to try to keep it on the rails today, sharing a lot of graphs. We're going to switch it up and cover some different areas of the market. We'll keep our comments concise and targeted. I'm going to try to go a little bit slower. This is all based on great feedback from our watchers and listeners and readers. So I'm going to share my screen and let's get to it. The silver lining of this type of environment is there's no shortage of things to talk about. So let's get on with it. All right. So I've shared this graph before in past reviews, and I really like it because it zooms out a bit. And this goes from May 2017 to May of 2022. And again, this is just an S&P 500 proxy. It's an ETF, SPY, and there's been a lot of chatter about hitting a bear market. We almost breached that magical 20% drop, and there's nothing sacred about that. Some academic from the 1970s said a 20% drop equals a bear market, so don't get hung up on that. But it is significant from an algorithmic standpoint, a investor sentiment standpoint, just a potentially changing investors' appetites for risk once they breach that mental threshold. But you can see these various levels. I mean, we're still a ways from the COVID crash low, which would be 46% down from these current levels. Pre-COVID high would be another leg down of 18%. And we've had a little rally in the last week or so to stop a series of negative weeks, which is kind of nice. So we're a little ways from this 20% drop, but again, nothing really substantial here. Just providing context for where we've been over the wild last couple of years. Zooming out even further, some of the commentary I read and listening to investors and potential clients, like they're ready to throw in the towel on this market. And again, when we zoom out even further, post-financial crisis, which was the low in March of 2009. This has been a pretty magical run. I've coined this the golden decade for investors, and we're on record saying periods of stability and healthy returns are often followed by periods that are difficult and potentially downside returns or downside market action. And that's what we're seeing here. So this, I would argue, is not normal, right? Or less normal. This is more normal with historical levels of volatility. Again, the Fed has kind of mucked up this business cycle. They've kept rates low in response to the financial crisis. They've done everything they can to keep the wheels on. And now during this period of normalizing and resetting investors' risk appetites, you can get some of this. And of course, the pandemic didn't help either. So if the Fed mucked this up, their fingerprints are all over this as well. So, I've said this before, I'll say it again. This is not a normal business cycle. So it would be a mistake to take past cycles, past monetary policy cycles, even fiscal policy, and use that to try to explain or predict what happens next. So my message to you, a true investor that understands this has a better chance of sticking to a well thought out long-term plan. An investor that shuns this, trying to market time, usually ends up with egg on their face. So throughout the market noise, we're constantly trying to see which factors are in favor. Okay, so all this is a snapshot of the U.S. equity market, and we're looking at trends or changes or factors that are in favor since May 11th. Okay, and I shared one of these matrices back. Can't remember if it was last month or the month below, but that matrix was basically the opposite of this matrix. Okay, so let's just touch on a few of these. So market cap, that's simply the size of the company. Okay, so in decile 1, in column 1, these are smaller companies. And as we move to the right, the companies get bigger. Okay, so how I would read this, market cap low to high, lower cap or smaller companies really outperformed since the middle of May. Okay, so large cap trailed, small cap was really in vogue. Dividend yield. So we're going to get to this a little bit later, but dividend yield has been one of the stellar factors in 2022, meaning it's performed very well. dividend factor investing, dividend investing has really been out of favor for the greater part of a decade, really, just because dividend payers tend to be more value tilted companies. So think financials, industrials, energy, consumer staples. Those have trailed on a performance basis versus technology or growth. That's flipped in 2022. But you can see for this brief period, again, since May 11th, dividend payers, which would be here, and as we move to the right, that means companies are less likely or pay lower dividends. And over here, this is companies that pay no dividends really outperform. So this is probably the more tech-centric growth name here, which again, if you look at my previous video, this was the opposite, right? Where higher dividend payers were really outperforming and these more growth-centric companies were underperforming. So the message is not to draw any conclusion, but what's in favor, what's out of favor can flip, and it can be very quick. And I guess if you take into account decile 8, 9, cheaper companies were still in favor, but you can see there still was an appetite for companies that were trading at a higher multiple on a price to book basis. Same for price to sale. So what this is telling me is lower quality growth was back in vogue for a time. Okay, so this is not a very large sample set here, but again, these trends were basically the opposite for most of the year, and now they flipped over the past couple weeks. So this is just interesting. Again, there's no absolute conclusions to come from this. I just find it thought-provoking that a lot of these trends, like high dividend payers, lower, more attractively valued companies, kind of fell out of favor the last couple weeks. And here's that dividend factor, again, zooming out, where we can see 2022 starts here. You know, there's not a lot of factors or asset classes that are positive this year, but if this marks the start of 2022, you can see this line here is higher than the start of the year. Oops. Okay, so dividend investing is very much back in vogue, and it has less to do, I think, with dividends, although it probably has something to do with dividends. People want the certainty of a bird in hand today. But again, when you kick the tires on what is actually in this index, this dividend ETF, it's a lot of energy, financials, industrials, staples, utilities, sectors that traditionally pay dividends, and again, tend to be a little more stable just because they're old economy stocks, right? People need electricity. They need heat for their houses. They need gas in their tank to drive to work. So just less cyclical type of businesses, which tend to hold up during periods of stress. And that's what you're seeing here. All right. So this is kind of a faint font. I hope you can see this. But what I wanted to show is how some of the mega cap stocks are holding up. And people ask about the market. You know, I think you do yourself a disservice without acknowledging how much some of these large mega cap tech companies, how much of the index that they comprise. And it's certainly been a rough year for tech. It's been a rough year for some of these darling companies. And, you know, we look at a lot of portfolios for potential clients, and these names make up a huge chunk of most retail investors' portfolios. And look, it's been a really good trade the last 10 years. But I think sometimes people forget that these names, while they've been great, are not immune from some of these aggressive drawdowns. So you look at some of these crooked numbers here, YTD is year to date, and you can see Meta down 42% in 2022, Amazon down 31%, Apple's down, that's kind of hard to see, 15.5%, Nvidia down 36%, Tesla down 28%. So while these are great companies, we've been talking about this theme for a while that sure, you can enjoy market level returns, but for investors that are parking a huge chunk of capital, a huge chunk of their portfolios into these names and expecting these 30% annualized returns, you're probably going to be disappointed just because these companies have gotten so large. It's just, it's so hard to double in size from their current levels. So that's just food for thought. And again, this is partly why some of the reason why people feel worse this year than they did during periods like 2020 or 2008, just because the average investor performance is much worse than the broader indexes. It's much worse than what's going on in the bond market, much worse than what's going on in the S&P even, just because, one, these companies explain a lot of the S&P's performance, but people own these names outright in pretty decent concentration. And I think this is interesting too. So this is a piggybacking off of that previous chart where we're going back to 1982, tracking Apple stock drawdown from all-time highs. And nothing against Apple. This is just a commonly held stock. So, this applies to a lot of people. So we're going back 1982, just capturing drawdowns. So these blue lines that go down are actual Apple drawdowns from all-time highs as we go through time. So you can see as Apple's matured and gotten bigger, these drawdowns have become less aggressive, but they're still pretty substantial. So the red line captures the historical average of Apple drawdowns. So all of these in aggregate, the average drawdown for Apple is about 32%. And then the blue line is the current drawdown, essentially. So about 21%. And the story here is, one, Apple's still below their historical drawdown, so it could potentially get a little worse. But the story is, although these are great companies, they're not immune from some of these nasty downward moves, right? There's no foolproof way to enjoy the gains without experiencing pain. So this is just a reminder that, although Amazon, Apple, Google, Microsoft, these are all great companies that I personally own, we own in our client portfolios, but this is a good break check back to reality that they're not immune from pain. And not to beat a dead horse, Amazon's a much younger company than Apple, but same song and dance here. We go back to 97 and we look at historical drawdowns for Amazon. Again, as Amazon has matured through the years, these drawdowns are less intensive, but they're still intense nonetheless. You can see our current drawdown is actually about 41%, which is worse than the historical drawdown of about 30% for Amazon from all-time highs. Okay, so there's a lot going on here, and there's a few things I want to touch on, so don't freak out when you see this and your head wants to. So sometimes as U.S. investors, we can get sucked into what's going on in this country, and that's fine, but it's important to look at the opportunity set of investing, because our job is to skate where we think the puck is going, not necessarily where it's at today. Markets are forward looking, so I think this is a good touch point every now and again just to see what's going on in foreign markets. Okay, so you see all the countries here. So these are a mix of developed countries in emerging markets. And here's the ETF proxy for each of these countries. So if you wanted to invest, you could find one of these ETFs. And a few things stick out to me. One, we talk about PE ratio, meaning how much we're paying, how cheap or rich a market is trading at. And you can see some of the green highlights mean the market is actually very attractively valued, which again, being attractively valued doesn't mean that's a green light to shovel money into a certain country or asset or stock. It just means they're trading cheap, and oftentimes they're trading cheap for a reason. This is just one data point that we would take in and consider when we're evaluating an investment opportunity. So red means the country in this case is trading more towards the frothy or fully valued. Green means they're attractively valued. So again, looking at these extremes, Russia has just been decimated, is trading at a less than 4 PE, which is absurdly cheap, but they're cheap for a reason. And while US values have come down, they're still, looking at the global opportunity set, still closer to fully valued or overvalued versus the rest of the world. And then dividend yield is interesting to me too, because a lot of investors, especially folks that are retired or about to retire, want income. And I think a great place to look, and I've said this before, I've blogged about it quite a bit, is looking at foreign equity markets. I mean, you could see some of these green yields in Russia. I'm not advocating for that. I wouldn't touch Russia. But looking at the US, a dividend yield, just owning the index of the S&P, 1.58%, you could basically throw a dart at any of these other markets and you could get close to 4%. I mean, look at the UK, look at Sweden, 5%, look at South Africa, 4%, Italy, close to 5%. So Australia is another one. So being a little more intentional and targeting certain factors in certain markets that you like, you could, an investor, and this is not a promise, but you could pretty easily clip 4 to 5% in a global dividend index, which actually Pure has their own index that we've created. So if you're looking for yield, it might make sense to look outside the US. The other thing that I find interesting are these global inflation rates compared to the policy rate. So this would be like the Fed funds equivalent for all these other countries. And let's just look at a few of these. So Brazil has a policy rate of 12.75% and inflation of roughly 12%. So that would make sense. The Brazilian central bank is trying to mitigate inflationary pressures by increasing their policy rate. Okay, so this makes sense. Okay, you can see some of these other countries that are behind. Let's look at Germany, actually still a negative policy rate despite inflation of being 7.4%. So I would say the German central bank is even further behind, or just as far behind as our Fed here in the US. Again, you look at Mexico, their policy rate, 7%. Mexican CPI, 7.7%. So, I would say the Brazilian central bank, the Mexican central bank are doing a good job of trying to mitigate inflation with moving up their policy and making borrowing and speculation more costly. All right, let's go down to the US. This is why the Fed has backed themselves into a corner. 0.83% on their policy rate with inflation running at 8.3%. Ideally, you'd want the policy rate to be closer. I'm not saying it needs to be parity or it needs to be 8%, but this ideally would be higher. So the Fed is certainly behind the 8 ball here. And this is why investors are worried. The Fed is worried. And this is why they're in a lose-lose situation. And we'll get to the other side of this equation here, the other risk, which is softening economic activity, which is happening right now, and the Fed increasing rates. So on one hand, the Fed wants to increase rates to move this number down. On the other hand, if they increase rates into a slowing economy, that could push us off a cliff into a recession. So again, this is not a enviable position the Fed has put themselves in. And this is just a cleaner look at what I just covered. So again, country stock market PE ratios by trailing 12-month earnings. The US is still on the expensive side, along with the UK, Japan, and India. On the cheaper side, Brazil, Hong Kong, South Africa, South Korea, Taiwan, Germany, Italy. So, if you're a value investor, this would be a reasonable place to start looking. And I'm gonna do a post about where a value-based investor should start looking, because there are pockets of opportunity. And right now, people are more prone to sell something and hunker down in cash. In reality, that's not what you should be doing in a market like this. You should be sniffing out opportunities to deploy capital, especially if you're a long-term investor. And again, there's more to come on that front. And again, if you're looking for dividend yield, again, you should be hanging out in this neighborhood: UK, Norway, South Africa, Malaysia, Australia, Italy, Sweden, and Brazil. You can see on the other end, just owning the indexes here in the US doesn't leave much in the form of dividend income. I mean, even in the middle, in the belly of this graph, you can easily around 3% just owning a passive index. So if you want dividend yield, look outside the US. That's a good place to start. So in the past, we look at investor sentiment. Now we're looking at consumer sentiment, which, if you overlaid the two, they'd be pretty similar. But what I find interesting in some of these troughs of sentiment, right? So now during COVID, we had a market event when the government was downgraded from AAA to AA with the debt ceiling debacle back in later 2011 and early 12, coming out of the financial crisis. Like, if you invested at these troughs when people felt like crap, you did pretty well. I mean, this doesn't show the S&P, but just knowing what markets have done in the past, an investor would have done well when people feel the worst. And this is true for investor sentiment. It's true for consumer sentiment. Just doing the opposite of how people feel is likely a decent strategy. But unfortunately, investors end up doing the opposite, right? When they feel bad, they end up selling things. They don't buy things. And throughout history, an investor would have been rewarded for buying stocks at these levels. I'm not advocating that you do this, so this is not advice. This is just a blanket comment based on market history. And that goes for goods too. I mean, think about this time period, right? No one wanted to buy a house here. Like, the government was handing out credits for people to buy homes. Interest rates were ridiculously low. Housing prices had crashed, if you were buying anything at this point, you probably got it at a pretty steep discount. But most people end up making buy decisions or chasing performance and shoveling money here when they feel the best. That's historically not been a good strategy. So again, sometimes we forget that markets are made up of humans. Humans are notoriously horrible at allocating capital during periods of euphoria versus periods of pessimism. And most would be better off investing when people feel the worst or buying big ticket items when things feel the worst. Again, not advice. Housing market. So, if I was to stack up a list of worries on my end personally, housing has to be near the top. And I think housing has been a great place to be, whether you think of your house as an investment or just a place to live. It's had a nice tailwind at its back with low rates and shallow inventories and just not a lot of supply out there, very competitive buyer's market. There's certainly been some FOMO, a fear of missing out. If you're a first-time home buyer, you feel like you need to buy now because home prices are going to keep going up. That's really supported the price of houses. But now you're starting to see some very obvious cracks in the foundation. And I'm not a housing expert, but I have ears and I talk to people. And even amongst real estate professionals and mortgage brokers, they're really starting to worry because the equation just doesn't add up. And a big input of the housing equation is borrowing costs. And this has been a pretty ridiculous move from sub 3% mortgage rates to over 5%. And this actually hit close to 6% a couple of weeks ago. It's fallen down a little bit as bond yields have come down. But I've seen some calculations that this would almost double a mortgage payment for a home buyer. So I got news for the real estate bulls out there. If stocks go down, if the economy slows down, if investors are suffering, if the crypto markets go down, real estate is not exempt. Okay, look back at every cycle, and the most obvious recent cycle was 2008. And sometimes I think that real estate is a heavily indebted asset class, and what debt does is it amplifies outcomes, both good and bad. So when the real estate market crashes, it's amplified because a lot of people take out debt. A lot of people have mortgages. A lot of people have reached and bought houses at elevated prices. And I'm not trying to scare anybody, but this is not immune. A wise person once said the real estate market is the market cycle. This has kind of been could be the last shoe to drop. Real estate prices have hung in there pretty nicely, but if you're looking for the next shoe to drop, real estate could potentially be it. And these are some of the numbers from April. So a lot of the housing numbers we get, there's a pretty good lag on them, but you can see even in April where you're getting these year over year softening sales volumes. So volumes are down across the board when we look at trends from April 2021 to April of 2022. And, the thing that's a little confounding about real estate, you can see it's not a centralized market, meaning what's true out west is not true in the Northeast. You can see the Northeast has really bucked the trend. I don't know the reason why. I'm not in tune with Northeast real estate trends, but you can see in other markets in the Midwest and South and the West, sales volumes are down. And that goes for existing homes under construction, not started yet. Volumes are down across the board. And then you look at inventories. Inventories are up across the board, again, except for the Northeast. So some of these numbers are pretty big. I mean, these are pretty big moves over the course of a year. So the takeaway is sales down, inventories up, borrowing costs higher. You would think this would put some stress on home prices. And you're already starting to see, like I have Zillow and Redfin alerts set up on my phone. In the Camas market, we're starting to see some price cuts. I've talked to clients in Seattle, not really seeing any price cuts, but houses are staying on the market a little bit longer. So again, it's not a centralized market, but things are starting to soften in general. And look no further. So again, this is a kind of a softer font. I apologize for that. But this is a composite of national home builders. And this goes from December of 2021 through May. So the numbers don't lie. Price action doesn't lie. A lot of these national home builders getting absolutely crushed. So they're down 40, 50, 60%. And this is just a composite. So this is also kind of a canary in the coal mine saying there's trouble in housing. Okay, so again, this is a bit messy, but what this is stating, and don't get sucked into any of this, but again, we're looking at trends here, and this is just economic trends year over year, and we actually can track it through the month. So this is May of 2021. This is through the end of April of 2022, and this is the Fed's conundrum, right? Inflation is high, borrowing costs are still relatively low, the Fed funds rate is still low, but economic data across the board. So this is manufacturing output, services. This is starting to get a little softer. There's more red than green here. Labor markets are starting to soften up a little bit as well. Housing is definitely starting to soften, right? So red means softening, green means actually increasing. And then you can see inflation. These are all green, and now we're starting to get some softening in inflation. I'm not saying it's peak inflation, although the bond market might be sniffing peak inflation out. The bond market's starting to behave a lot better. Yields are starting to come down, which could mean it has peaked. These numbers could support that thesis. But the risk is economic data softening, inflation peaking, and the Fed hiking aggressively, pushing us into a recession. So again, not an enviable spot to be in if you're the Fed. They've backed themselves into a corner. The biggest risk, in my opinion, is a policy error by the Fed or a meaningful decline in housing, which again is many times the biggest asset on Americans' balance sheet. That would affect a lot of activity, a lot of economic activity, a lot of sentiment out there, a lot of investors' appetite for risk. So those two things are the most important things that I'm watching, that we're watching at Pure. Again, it's not a prediction of what's to happen next. As you can see, things move quickly. If we got a backup in inflation, if inflation did actually peak, that would make the Fed's job much, much easier. And the markets would likely react in a favorable manner, just because that would allow the Fed to be a little more methodical in their hikes, to be less aggressive, space them out perhaps. So again, there's a lot of noise in this environment. It's really tough to capture the signal amongst that noise, which is why you need to be flexible. You need to be open-minded. I'm still amazed at some of the narratives that I hear out there, both from professionals and retail investors, about what happens next. Like, they're very certain about what happens next, and they'll explain to me these very specific paths of what happens from an economic standpoint, how the markets are going to react, how the Fed's going to react, what happens globally, what happens with Russia, Ukraine. And it's like, man, if there's anything I've learned over the past 2 years, is that nobody knows anything. I mean, you just go back and look at Wall Street notes in 2019 and 2020, the predictions, and these are very smart people, very fancy sounding narratives, but literally nothing that they've predicted has come to fruition. And I think as investors, we need to be humble. We need to be open-minded, and don't create this identity that I'm a bearish investor or things are going to get better. I'm an optimistic investor. I'm a tech investor, because that can get you wrecked. So enough of that. I hope you enjoyed this. Feel free to give me any feedback if you'd like to see different data points, a different format, a different style. I'm happy to accommodate all that. And I weaved some of that into this episode as well. So thanks for watching. Thanks for listening. Take care.